Thank you. Well, thank you everyone for joining us this afternoon. This is Trade Finance Basics, which is episode number 4 of the Financial Ploys Business Borrowing Basics series. You can find more about financial ploys on slide 38, as well as slides 7 through 10 will summarize the series and provide a list of all of the episodes in the Business Borrowing Basics series. I have the pleasure today of being your moderator. So as he said, my name is Jacqueline Brooks, and I am a corporate partner with the law firm of Dwayne Morris, LLP. Let me take this time now to introduce my fabulous panelists. We have with us Andrew Chong, who is Vice President and Chief Operating Officer of King Trade Capital. Also, Jennifer Draftcorn, who is a Senior Vice President and Portfolio Manager of Rosenthal Trade Capital, a division of Rosenthal and Rosenthal. We understand that today you are not here to hear infomercials about each of us. So you can definitely find that information, our bios on slides 34 through 36. Speaking of the slides, we will not be stepping through the slides one by one, and we will definitely not be reading from the slides in this webinar. This, like all Financial Ploys webinars, are meant to be a conversation. But definitely keep those PowerPoints handy. I will pull up and point to certain slides as we go through, as they are great reference tools, and you'll be able to have them for later on. Financial Ploys is supported in part by sponsors. The sponsors of this webinar are Mood, the nation's premier online retail cannabis dispensary; Sunburst Digital, maker of Type to Learn, the #1 typing app for children, K through 12; and Max Asset. If you need to conduct an online auction, Max Asset is your turnkey solution. More information about these sponsors, Mood, can be found on slide 3, and information about Sunburst and Max Asset are highlighted on slide 4. If you are attending this live premiere, if you're attending the live premiere of this webinar, you can submit your questions using the portal. If you are watching this on demand and you have any questions whatsoever regarding the webinar, definitely please send those questions to info@financialploys.com. Just include your question and the name of the webinar episode, and we will do our best to get you the answer as soon as possible. We repeat this information on slide 38, so there you go, another good reason to make sure you keep them handy for reference later on. As slide number 5 states, it provides the lovely disclaimer, which, as many of you, as an attorney, I can appreciate. But the PowerPoint and conversation that we are about to have is meant to be general information purposes, and is not for you to act on without actually talking to the appropriate advice of an advisor. So in sum, we are not your lawyers, accountants, bankers, or other advisors, and definitely encourage you to consult with them in order to determine the best result for your specific situation. All right, so that was a mouthful. Now that we have all of the housekeeping out of the way, I am sure everyone is ready to get this conversation started. So let's take a step back and see if we can set the stage. Andrew, can you tell us what is trade finance and why is trade finance important?
Sure, absolutely. And thank you for the introduction, and really excited to be on this webinar and have this conversation with everyone. But yeah, ultimately trade finance, I guess the best way I would go about describing it is it's a diverse array of various techniques or financial instruments that can be used to help mitigate the risks in ultimately international trade. Certain instruments that we use ourselves here at King Trade Capital and various other finance companies such as Rosenthal. Jennifer is very familiar with these instruments as well, but whether it be letters of credits issued to suppliers, payment against presentation of original shipping documents, credit guarantees, supply chain finance, cash in advance scenarios. The list goes on and on and on. But ultimately, the goal is to help facilitate a secure payment to exporters and it ultimately guarantees timely delivery of goods for those buyers. And through trade finance, we're able to turn kind of cross-border, I'll call it trade opportunities into tangible transactions, while also being able to effectively manage the risk for both the exporters and importers. It's a great tool, and I think I read somewhere that the value of trade in goods total worldwide was somewhere around the ballpark of $25 trillion. And so yeah, this is something that I obviously deal with on a day-to-day basis, but there's just various different tools that can be utilized to help mitigate the various risks when it comes to international trade.
Yeah, and I can imagine with companies being so, with business being able to be done virtually anywhere,
Sure. Sure.
across borders, trade finance becomes more and more important as we are easily connected.
Yeah.
What would you say are you mentioned some of them, but what are the typically the parties that will be involved in trade finance transactions?
Sure. So I'd say, the main parties are obviously you have your importers who are ultimately the buyers, the end customers of the goods that are whether it's being imported or exported. You've also got, the suppliers, the exporters who are ultimately they're the ones producing and shipping the products to those end customers. You've got the respective banks of both the importers and exporters, and then you've got whether it be traditional bank that's providing a trade finance solution, or you've got alternative lenders such as King Trade Capital and Rosenthal, such as ourselves, providing the service. So those are the main parties, and I'll take it a step deeper. And there's a lot of paperwork when it comes to trade finance, and with the various checks and balances that we require when it comes to making payment on shipments. But there are a lot of different parties that come into play. You have to take into account who the freight forwarders are that are handling the actual products, the actual goods. You've got the custom agents who are clearing those goods for you. And if goods are flowing into perhaps a third party warehouse where they're being staged prior to shipment to a final end customer. So it could get a little bit complicated, but I'd say the main parties are the importers, the exporters, the respective banks who are representing those importers and exporters, and then you've got various other parties when it comes to the certain details of different types of transactions. But yeah, there can be a lot of parties that can involve in these opportunities.
Yeah, sounds like it. Like it's its own sort of ecosystem there.
Absolutely.
So now that we have that background, let's talk about how trade finance might be used by a business. For our purposes today, this business is a wholesale luxury fashion business owned by Sandra. Sandra imports fabric and other textiles from various jurisdictions, and has started exporting designer clothes and shoes to Europe and Asia. One of Sandra's new buyers is located in Tokyo, and Sandra is nervous that she does not know much about the company other than the fact that it's a small startup. I'm sure there are many small businesses that may end up in similar situations. Jennifer, what would be a good option for Sandra here if she does not trust that she will be paid timely on the order?
Thank you, Jacqueline. Hi, everybody. I'm happy to be here. And like Andrew, this is where I'm at. I'm immersed in trade finance all day long, every day, and have been for many years. So in this scenario, Sandra is actually the exporter selling to somebody in Tokyo. So let's say she's in the States and she doesn't know anything about the company that she's selling to over in Tokyo. One way that she could protect herself on the sale is to ask the buyer to get a letter of credit in place that would provide the basics, the parameters with which she would be willing to sell them.
Okay.
So that letter of credit typically would be used to govern the relationship, the sales relationship. And you have parties to that. You have your beneficiary, which would be Sandra at this point, because it's her company that is getting the money out of this. You have the buyer, which would be the company over in Tokyo. That buyer has to go to their advising bank, a bank that they work with that has international trade capabilities, and get a letter of credit posted to Sandra. Within that letter of credit, you're going to talk about things like the latest ship date, what ports you want it shipped out of, and what ports you want it shipped to. The documents that Andrew was talking about, the many amounts of paperwork that we go through, you would look at doing a commercial invoice that would spell out the sales value of what the merchandise is, the quantity of it, and then the sales value. You would have your packing list and your transport document, typically either a bill of lading or an airway bill related to that. The letter of credit also would spell out the shipping terms. Is Sandra selling this to the company in Tokyo freight prepaid? Or if it's coming from the US to Tokyo, does the buyer have to pay for the freight? Those are things that have to be thought about when you're putting together a letter of credit. Also, is it one shipment or multiple shipments? So you can get very comfortable as a seller if you have a letter of credit from your buyer with everything spelled out. You know that if you perform and you follow the letter of credit and you present documents to the bank over in Tokyo, you will get paid once she's put the goods on the water and the sale goes through. So that's one way, and that's a good, solid way to guarantee your payment. Another way is to potentially look at credit insurance on the buyer over in Tokyo. That can be done by a third party. It's typically not done within the trade finance package that you're working with the lender that you're working with. That's normally an outside company. And then also there are companies that do international factoring.
Okay.
So she could also look at that to see if a company that does do international factoring would credit approve this and credit enhance the fact that she has the sale.
And so in that credit insurance would be different than, for instance, like the insurance that may be needed for freight or
Correct.
Right. Okay.
That insurance, that credit insurance relates specifically to if the buyer doesn't pay Sandra for the goods, if Sandra has credit insurance covering that invoice receivable, the credit insurance company would then pay Sandra.
Okay. Now, are there different types of like letters of credit? Andrew, do you have any thoughts on that?
Yeah, so the two that I'm familiar with, we've got the documentary letters of credits whereby kind of the structure by which Jennifer was describing, presentation of specific documents tied to specific shipment dates and goods. That's what we're used to and what a lot of, I guess, finance companies and trade finance will issue. Is a documentary letter of credit where the supplier needs to prove that they produce the specific goods that are required and agreed upon with the end customer, and they're shipping that out in a timely manner, right, by an agreed upon date, and it's the quality of those goods are also going to be up to standard. The other type of letter of credit is a standby LC, and while we don't issue that, it ultimately is an instrument that guarantees payment if between buyer and seller, they have a separate contract saying, hey, seller, we'll pay you once you ship goods, or we'll pay you once you receive goods. But if they don't pay, that end buyer, my understanding is, can ultimately draw on that standby letter of credit, which is a payment guarantee in the case that a payment is not made under the agreed upon terms between the two parties. And I don't know, Jennifer, if you have a little bit more knowledge on standbys, but it's, I'll say it's something that we tend to stay away from, because ultimately, the beneficiary of a standby could then go and draw down on that instrument, at any given time, and get paid without proper performance.
We, in trade finance, we typically stay away from the standbys as well, unless it's a very long term transaction timing. So typically standbys are used when it's a longer transaction timing and there is specific like draw dates within the standby or payments that need to be made throughout the time period that the standby is open for. So the standby would never get drawn on if the payment is made outside of the standby. It's just there basically to credit enhance the sale that is in works. But for trade finance, typically we stick with the documentary letters of credit as well.
Good to know. So that way people will know if someone's saying they want to stand by letter of credit and trade, that they're probably way off base.
we do hear that from suppliers. They say they want to stand by, and our response to them is no, we're transactional financing. So we're happy to do documentary letters of credit, but not a standby with an open-ended dollar amount and an open-ended time frame. It just doesn't work to mitigate the risk in trade finance.
Okay. So what happens for the buyer of the goods? What would be the buyer's obligation to reimburse the trade finance company or the issuing bank that's issuing the letter of credit?
So typically when the buyer has an LC posted up by a bank, that bank, they already have a working relationship with that bank, typically, not always, but that bank looks at the creditworthiness of the buyer. And if they have a bank account with them, sometimes they'll even say, okay, we'll open the LC for you at 100% value, but we're going to put a hold on your bank account for 50% of that value. So the bank is taking that 50% as insurance. And that relationship, the seller can't help with that at all. That's between the buyer and the buyer's bank.
Okay. And are there any fees, Andrew, that would be associated with getting like a letter of credit?
Yeah, absolutely. So, every bank is a little bit different. I'll say with our bank, there's a fee to issue a letter of credit. There's a fee for negotiating documents, as goods are shipping, as a supplier shipping product, and they start presenting documents under letter of credit to get paid. There's a fee for the bank to process those documents, and they refer to that as negotiation fees. If there's amendments that need to be made to the letter of credit after the fact that it's been issued, perhaps you've got a ship date that needs to be pushed back due to certain delays, and those extensions are acceptable to the end customer. We need to go amend the LC to accommodate for that. There are typically fees for that. One of the things that a lot of providers of trade finance will require under the letter of credit are inspections, typically third-party inspections, to ensure that those goods that are being produced are, again, quality product that is up to par and will be accepted by the end buyer. So there's inspection fees that need to be taken into account as well. But I'll say for us, it's always, those fees are always derived from the value of the letter of credit that's been issued. So the issuance fee and the negotiating fees are a small percentage, but it's a percentage of the amount of that LC that's been issued. And then for the amendments, it's a flat fee. I've seen, those amendment fees be anywhere from $100 to $200, just depending on the types of changes that are needed. And then the inspection fees, while those are third-party fees, I like to kind of rope them into this because it's all tied to the letter of credits that get issued. But those will obviously vary depending on what types of inspections are required and who's conducting those inspections. But those are fees that I do believe need to get taken into account under an instrument like a letter of credit.
Definitely. And I guess what would happen in situations, especially if you're dealing with sort of going back to where when Jennifer was going through sort of the documents and things
Sure.
that are provided for the letter of credit, if they provided sort of I'm probably going to say it wrong, either the bill of lading or the invoice that has the itemized list of items that are actually
Sure.
supposed to be packed, but when they get there, they're damaged or not the full amount of what's supposed
Right.
to.
And
Situation.
yeah. So, ultimately when documents get presented, those documents are reviewed by the bank. And if there's any discrepancies, like goods have shipped late, the items aren't what they're supposed to be, those discrepancies pop up, you get a message from the bank. So we review those discrepancies, we review them with the client to ensure that, it's not going to have any issues in terms of, being able to deliver those goods and get successfully paid from the end customer. Now, yes, tons of horror stories, especially during COVID, where we thought we were buying a box of 1,000 medical gowns. You open the box and it's literally rocks in the box. And that's where insurance comes into play, right? Insurance, and that's why with all our transactions, we require that the client have sufficient insurance, for situations that arise like that. But I go back to when I talked about the inspection fees. It's so important to have the proper inspections in place to ensure that, again, I talk about the quality, that's super important, but there's also certain inspections like loading of the containers. So someone actually sits there, watches the goods and these boxes get put into the containers and watch the seal get put onto the container, which is ultimately a lock. It's got a serial number. It should never be opened again until it reaches the port of destination. But we take those steps to ensure that those things don't happen. But yes, there are horror stories that happen to us. Luckily, in our case, I'll say, rather than insurance, there's enough margin on other transactions to help cover what had happened. But a lot of horror stories of, hey, I thought I paid for, whatever it might have been, and literally you're getting, a box full of rocks instead of the goods. But I think there's a lot of preemptive steps that can be taken to prevent that.
Sounds good. So diligence of both parties,
Yeah.
as well as the advisors that you're using to make sure that you're thinking through these things.
Right.
Makes sense. So let's go back and talk about Sandra a little bit more. As mentioned, Sandra imports a lot of fabric and other textiles from designers. She has now ordered a big shipment from mainland China from a new supplier, but when she opened it, it was horrible quality fabric. Maybe she thought she was getting silk and it ended up being something not quite that. So the Chinese supplier required Sandra as a buyer to get a commercial letter of credit issued for the supplier's benefit and the confirming bank. So it sounds like she would have to go through all of those items that you just mentioned, Andrew. Jennifer, have you had any situations similar to that?
Yes, definitely. Actually, this goes way back. I'm dating myself. When I was in the apparel industry, opened up a box of raw silk garments for women, and the smell was horrific. So fortunately, the supplier that was providing that had insurance. Something had happened during transit, and an insurance claim was able to be made. But that's not always the case, because in the letter of credit, the bank looks at documents in black and white. So the scenarios that Andrew just described, if the bank documents come in and they're 100% clean, you cannot stop the payment to the supplier on that in that respect. So in the case of this, where the quality of the fabric was horrible, if the LC has already been paid, it's more difficult for Sandra to recoup her funds, which is why I want to stress, just like Andrew did, you need those third-party inspections. They're important. I know, we hear it from our clients all the time. Oh, I've worked with the supplier for years. There's never been a problem. And more than likely, there's probably not going to be a problem. But they're there for a purpose. And as a lender, we, typically do require them. Very rare circumstances where we don't. So under that scenario, if the LC had not been paid, Sandra could immediately alert the bank and let them know that the quality was horrible and I don't want the payment to go out. Again, if it's 100% clean documents, the bank can't stop it. The only way to stop that then would be to run into court and put a temporary restraining order in place. Had to do that before. Doesn't happen often, but it does happen. But if the letter of credit had already been paid and then the boxes came in and Sandra opened them up, she really has to rely on her relationship with the supplier overseas. Maybe she's got another shipment coming, down the road in a month or two. A credit can be applied to that shipment. I would definitely recommend to her, if she has to do that, definitely get that third-party inspection done on the goods that, are 2 months out. But that is an area where the importer can get left holding the bag sometimes. Because if the quality is not good enough to sell as a first quality item, then you have to try to offload it. You're only going to get, pennies on the dollar compared to what you would get for your whole value.
Yeah.
I had a recent scenario actually earlier this year where a client, they were importing handbags for women. And they had worked with the supplier for many years, and it was a small transaction. It was only $15,000. So we let it go. We let it go without an inspection because we had worked with this factory for a while and there had never been any issues. So the shipment comes in, it gets into the third-party warehouse, they open it up and start counting. There was a lot of excess packing materials in there along with handbags. So the weight measured out to they shipped 100% of the goods that they were supposed to ship and what was on the commercial invoice, but only half the goods were there.
Wow.
So now our client was lucky, and this goes back again to the, while there wasn't a third-party inspection, the setup with this one was with the supplier overseas. The freight forwarder came in, loaded the cartons from the factory. So the freight forwarder was able to tell the insurance company after the client put in the claim that we saw these boxes. They weren't ever opened after they left the factory floor. And because of that, the insurance company actually agreed to a payout. So our client was able to recoup some funds, but that's not always the case.
Right.
Yeah. And so sounds like moral of the story is, although those fees may not be, you may not want to pay the fees for inspection, or you may not want to pay the premium for insurance. Sometimes getting that and making sure you're going through that will save you a lot. In the end, it will definitely be less than having to go to court to enforce it.
And not only do you want ocean cargo insurance, you want to have domestic cargo insurance too, for the time period that maybe you're responsible for delivering from the warehouse to your end seller's distribution center. If you don't have domestic cargo insurance and something happens with that truck, spills over or tornado comes through and that you wouldn't have any coverage for anything then, other than the trucking company may say, we'll give you a basic like $500 on the shipment, but you're not going to have dollar for dollar coverage if you don't have separate insurance. And also, if you're working with a third-party warehouse, you want to have insurance there too. I had an instance, again, I'm dating myself. We were financing a company that did Nintendo video games. Obviously, there's not any of those anymore. But the third-party warehouse in California where they were delivered to had a fire. And the merchandise just all disintegrated essentially during the fire. So if we hadn't, as a lender, asked the company to have insurance coverage on the third-party warehouse location, we would not have been able to make a claim and get reimbursed for that from the insurance company.
Wow. Yes, Nintendo. I think Nintendo Switch now, most of their things seem to be available online.
Yes. This was a long time ago.
Yes, yes. I do remember them well, though. So for Sandra, one of her buyers in Hong Kong is insisting that all of the garment shipments arrive before it has to pay on net 90 terms after the shipment arrives. This sounds to me like, Andrew, that the buyer is insisting on open account terms.
Sure.
Can you sort of dive into, how that works and processing?
Yeah, I would advise Sandra not to do that. No, no, I mean, just for the sake of talking about this scenario, but yeah, ultimately, we like to say that Sandra would be, financing the buyer in terms of, hey, you're providing them with product and they don't have to pay you until, the agreed upon time, whether it be 30, 60, 90 days later. And you find that the longer those payment terms are, 90 days, 120 days, the more time it gives the buyer to go through the product and potentially come up with issues, excuses to, at that term, at the end of that term, say, oh, Sandra, sorry, half of this stuff, didn't look good, when in reality it might have not sold as well as the buyer thought and might not pay at a full amount as expected.
Mm-hmm.
So we find that's a little bit dangerous, but we do see people do it where it's open terms. It happens all the time in the US, domestic transactions. Walmart is infamous for stretching out payment terms pretty far on the clients we finance, but you see this a lot in domestic transactions, not so much international, but yeah, ultimately what the risk you're taking is you're providing goods prior to payment, and you're releasing your asset to the end customer without receiving payment until agreed upon time, that is 30, 60, or 90 days later, which can be a little bit risky. But that's where there's certain solutions that, if depending on the credit worthiness of that end buyer in Hong Kong, supply chain finance could be a great solution for that. And we can talk a little bit about that later. I don't know if right now would be a good time to jump into that, but ultimately,
we can jump into that.
yeah. So ultimately, with supply chain finance, there's various. It's kind of fintech led program solutions that buyers who have buyers who have great credit. Finance companies or banks will take on that risk of that credit and they'll buy that paper. So, let's say Sandra was selling to this buyer in Hong Kong and her terms with that buyer in Hong Kong was 90 days, but the buyer, that Hong Kong customer had a banking relationship that provided a supply chain solution because that bank felt that this buyer was a great credit. Well, Sandra could ultimately, as she delivers goods and uploads those invoices into the bank's platform, she could ultimately sell that paper, sell those invoices, sell that accounts receivable kind of in an open market to various different other lending companies who will pay a discounted amount to Sandra for that delivery. And typically those advances are much more aggressive and at a lower price than what a factoring company can provide, because of it's simply due to how credit worthy that end buyer is. Yeah, so it could be a great solution if you're selling to some good credit worthy customers. And I've come across it more and more these days. And there's some big fintech folks that provide it. And while Jennifer and myself, we do all the hard work on the front end. We work in tandem with these supply chain finance providers who, when these goods do get delivered, ultimately their advance times our financing at that point, and we look to fund the next round of shipments for our clients.
Mhm.
Yeah, definitely. I can see how that liquidity helps.
Absolutely.
Do you have any thoughts on the supply chain financing? Seems like it would be something that definitely would be picking up now.
It is. And then actually the first scenario that we went through, where Sandra had a buyer over in Tokyo, supply chain financing could have been possibly used in that scenario as well. It's used a lot, as Andrew said, when the buyer wants longer terms, because the seller wants working capital quicker than 90 or 120 days out. So it's great for those bigger box stores or volume stores like your Walmarts, your Costco's, Kohl's, Targets. A lot of those companies now have supply chain programs that they will tell their vendor, if you're selling into them, and say, hey, you might want to get into our supply chain program. And the supply chain program is typically run through either a third party or a lending institution. But we are seeing an uptick in those as well.
Okay. So it definitely sounds like the people or the buyers that would be looking for sort of the open accounts and pushing the sellers to supply chain would be those that have the leverage and connections to be able to do so.
Exactly. Right.
Okay. It's so in the somewhere in the slides they've talked about this like what is a bill of exchange in connection with supply chain. Can you what is it exactly that?
So it's used for letters of credit also, as well as supply chain financing. It's where the party that wants to get paid submits a negotiable document that basically states, you owe me X amount of dollars in X amount of time frame. So in a letter of credit scenario, every time the documents are presented for payment to the bank, there is a draft included in that. So there's still a commercial invoice, but there's also a draft demanding payment, essentially. And it will say it's either at site, meaning it gets paid immediately upon acceptance by the bank to do so, or there's a maturity date on it. And if there's a maturity date on it and it's going through the bank, the payment just automatically essentially gets swept out of the account on that maturity date. So in some respects, on the documentation that Andrew and I look at on a day in and day out, we don't even see the draft. If there's a letter of credit surround, overlay in the transaction, that draft document goes straight to the bank, and the bank processes it as part of the LC payment. During the supply chain scenario, it is essentially, it's that bill of exchange where you have the party that says, I want to get paid because I sold you this and you need to pay me right now or on a maturity date. So both of them are very similar. One thing that I have learned over time that I didn't know this is you can only extend the draft out for 3 months or 30 days. So a maturity date cannot go beyond that.
Oh, wow.
And that actually, a draft or a bill of exchange is actually regulated by the Board of Commissions with the Federal Reserve System. So there are parameters that I didn't know this for several years when I was working in the industry, because most things were letter of credit at that point in time. I just knew it went along with the letter of credit. Now that we're looking at other types of trade finance, international wires or documentary collections, supply chain financing, the drafts and bill of exchange have come into play more. So we had to get a little bit more comfortable with them. But from the party who has to make the payment, they don't have to do anything for the bill of exchange. It's the seller's party that says, okay, I sold you this, you now owe me money. So they have to create that draft or bill of exchange.
Got it. Got it. And so in connection with these things, like, there's the money that's being paid out under the letter of credit, there's the goods that are being shipped. Do the finance companies or the banks, are they filing like UCC1s or anything in connection with any of this that's happening?
So letters of credit and documentary collections, which are run through the banks, are essentially governed by what is known as UCP 600. So it is international. I can't call it law because it's not necessarily law. It's recognized standards within the international trade finance industry that the UCP 600s has to be the overriding the overriding documentation. I'm not saying this well, I apologize, everyone. So what it's meant to do is tell a bank in the US and a bank in Germany that if you get a set of documents, you better be looking at that set of documents the same way. Because in UCP 600, there's definitive documentation requirements written in there for every type of document that would get presented under a letter of credit or a documentary collection, a standby LC. This book kind of overrules it. It's interesting though, with trade finance as big and powerful as it is now in the industries, the UCP 600 has not been updated since 2007. And it kind of is mind-blowing that, that there has not been an update to that, because there have been many cases where the UCP 600 has gotten challenged because it seems out of date, especially when it comes to electronic documentation. Because that is, I don't know, Andrew, I'm sure you're seeing this too with the freight forwarders, and that the bills of lading are no longer paper. They used to be rice paper. Very thin wafer rice paper. And you would have the set of 3/3 original. And if you had a third, the bank had a third, and that other third wasn't accounted for, that was potentially problematic, because if somebody else grabbed that other third, they could potentially go to the freight forwarder and say, here, I'm surrendering that 1/3 bill of lading, I want my goods, even though they weren't their goods. But that really doesn't happen much anymore because you deal with electronic documentation. But the banks are somewhat challenged because the UCP 600 has not caught up to that yet. But
Very cool.
as you know, as a presenter talking to the crowd here, don't be afraid of electronic documentation. There's definitely been the whole industry of trade finance is now on board with electronic documentation. Took us a little while to, some were kicking and screaming going there. I actually love it. And you can, as a lender, if you get a PDF copy of a bill of lading that's saying it's been telex released, well, if you didn't receive that from the freight forwarder, it's really just a piece of paper that somebody could have stamped telex released on
Sure.
to release the shipment. So now there is a mechanism that you can go straight to the freight forwarder and get a confirmation or a verification that a telex release is active on that shipment. So as a lender, you don't have to worry that your client's not going to be able to go and pick up those goods, even though they no longer have that original bill of lading to surrender to the freight forwarder.
Yeah, I think it's been, no matter what part of the lending industry you're in, whether it's trade finance or other asset-based lending, there's been sort of a slow acceptance of things being done in electronic form, but I think we are all also slowly getting there.
Agreed. And I mean, I don't think you can find a freight forwarder out there anymore that doesn't do some form of electronic bills of lading.
Very good. So Andrew, one of the things that you mentioned that I want to go back to when you were talking about supply chain was the discounting.
Yeah.
So how is that discounting done and accounted for? Like how does that impact the seller?
Sure. So, ultimately when a seller submits their accounts receivable kind of in the open market, there's offers of what those discounts might look like. I'll say with traditional factors, they like to hold a little bit of a larger reserve, and the advance that you might be ultimately getting from that factor might be 85 to perhaps 90% of the value to AR. So if you've delivered on an order and the amount of that order was $100,000, the most you might be able to get might be $90,000. Now, with supply chain financing, because it's the credit worthiness of these end buyers are much better, and they're ultimately checking the box that they're saying, hey, yes, I've received these goods and they will get paid, or we will be making payment on this invoice. Those advance rates or those discounts tend to be much more attractive. And so I've seen it where a supplier is ultimately getting almost nearly 100% of the value of that invoice, minus a small fee for and it'll be titled the finance fee from that lender, but those advance rates tend to be much more attractive. And it's just simply because, again, you're dealing with much more credit worthy and buyers who have confirmed those invoices and have confirmed that they will be paying on those invoices.
Got it. And, I think what has been, there seems to have just been a lot more regulation in the lending industry, with a lot more companies joining, institutions, other alternative providers. How has that, and I throw this out to either, Andrew or Jennifer, and or both of you,
Sure.
how have you seen any sort of additional regulatory scrutiny, in the industry?
Yeah, I mean, I'll say for us, I mean, there's certain states that have certain regulatory requirements that make it more difficult for us to lend in those states. California, New York being two of those states where we now have, candidly, we've increased our minimums in some of those areas, in those states, in those regions because of those regulatory, requirements. So I think in California, if you're lending anything below $500,000, there's a certain there's a requirement of information that you need to file, and it's just something for us that, you know, we don't want to deal with, and we would rather and it's very difficult because, you know, they're trying to define, I guess, you know, what they want is very difficult in trade finance because, you know, every transaction is so different for us. You know, every timeline of transactions that we finance is different. You know, some transactions might be 30 days from start to finish. Other transactions might go 90 days. And so when they're trying to put you in a box, it just doesn't work for us.
Yeah.
Yeah, and so we tend to we have to increase our minimums to ensure that, hey, we don't have to, you know, file this information because it candidly wouldn't be accurate because it would always be changing, constantly be changing. Because the facilities we put in place for our clients, every deal is still very different for our clients. You know, a client may come to us with a Walmart PO, and for that Walmart PO, they might be working with supplier A, who's going to take 30 days to produce the product. And then that same client comes to us with a Target purchase order, and they use supplier B, who's going to take 60 days, right? And so, you know, and so it's just difficult to put that one client in a box and that solution in a box. And so we just, you know, it makes it difficult for us to work under a certain minimum because of those regulations.
Definitely. What about you, Jennifer?
Same thing. We're looking at deals differently now because of some of the individual states' commercial lending laws that have gone into place. It's difficult because, again, I go back to mentioning what we do is transactional financing. It's based on a finite time frame, and the commercial lending laws are looking at annualized interests and so on. So it's very difficult when we're talking to prospects or sometimes even our client. They automatically look at fees and rates on an annualized basis. But again, we're transactional. So does the profit that potential sale you have with Walmart warrant the type of rate that we're requesting for your transaction that may be a 60 or a 90-day transaction? You know, that's something that the client has to look at on their side. But it has given us pause, and it's also changed lending a little bit because we, you know, get calls from prospects all the time. You find out where they're located, and then the dollar amounts they're working with, we no longer have the appetite to help them when they're in that smaller growth stage, because of the regulations that have been put on lenders.
Right, because that increases costs for you guys and
exactly
those who have to get passed on. Yeah, no, that makes a lot of sense. Makes a lot of sense. I was definitely, I know some of the states, their laws, like California, I mean, even if you're just a small business, in some instances, you know, making loans to like a business-to-business loan, you can sometimes now fall under their
no kidding.
Their licensing laws, depending on how you've decided to structure it. So, you know, I guess we'll see what happens with these requirements. It's definitely has made it much more, as you've said, it's made it much more costly.
It's unfortunate. It is much more challenging. I mean, yes, we see a lot of deals out of California. We see them out of New York, and, you know, having to turn those down because of those, you know, requirements. It is unfortunate.
Yeah. So as we are coming slowly to the, or fairly quickly actually, to the end of our session, what would be, and I'll give each of you a couple minutes to talk about sort of what would be your advice as best tips for customers coming in looking for trade finance from a provider.
Sure. What I'd say is I do a lot of research on who you're purchasing from, who that supplier is that you've lined yourself up with producing those goods. Hopefully it's a company that's been around for a while. And the product that they're producing for you is something that that's their business, that's their core business. And in terms of who you're selling to, obviously it's always going to be good to sell to the big box retailers, such as the Walmarts and Targets of the world. But creditworthiness of those end customers is also very important when it comes to these trade transactions. And then in terms of trade finance itself and the various solutions, the biggest thing I'd say is the best way to protect yourself is to ensure that release of payment is not happening. You're not paying a supplier until goods have been produced and they've shipped and they are on their way to the destination. You don't want to pay, prior to shipment just because, they could, whether it be delays of that product being shipped or quality issues, we just always say, hey, look, if you can structure a transaction in such a way that you are paying after product has been shipped and you've inspected that product thoroughly, and you can confirm that it's on its way to where it needs to go, that's the best time to pay for that shipment or that product.
I agree with what Andrew was saying, and also want to add that don't be afraid to reach out to lenders, discuss the business opportunities that you have. We get calls a lot, or we hear about companies that ended up not calling and or reaching out because they are able to cash flow the majority of their business all year long. But then they get these opportunities out there, like the big box retailers, or you're selling to a government entity, and the volume of what you have to produce increases. Lenders can also look at, well, transactional finance lenders can look at doing just a one-off transaction with you. We don't have to look at having your whole business and funding your whole business 24/7, 365 days. So that is a good opportunity for people that have successful businesses or, are young in the industry and have a lot of growth coming. The trade finance programs can really help benefit those type of clients in the industry as they work to build their business and profits.
And that is how you definitely thrive, by continuing to scale. So
exactly. But I mean, as Andrew summed it up, we both work on the same basic business model. So what I agree with his assessment as well.
Thank you. And that brings us to our 4 o'clock hour here, or 3 o'clock central, depending on where you are joining us. And so that will conclude our webinar. And on those notes, I thank you, Andrew and Jennifer, for providing such wonderful insights and conversation this afternoon. Thank you, everyone, for joining us. We encourage you to continue watching Financial Poise, and this webinar and episode will be available on demand later. So if you feel a need to check back in, definitely do so. And with that, I will say good afternoon, everyone.